In the first quarter of 2026, the American economy grew. And around 74% of that growth came from one thing: companies building AI infrastructure. Not consumer spending. Not exports. Data centers. Over the last 2 quarters, AI capital spending has contributed more to American growth than all consumer spending combined. I have made 4 videos about pieces of this. Power bills. Entry-level jobs. A letter from the people building it. A lawsuit. This one is about the shape of the whole thing, and about a question none of those 4 answered. Who is actually paying for it? And I want to be precise about that number before I build anything on top of it, because it is exactly the sort of statistic that gets misquoted within a day. 74% is a share of growth. It is not a share of the economy. In level terms, AI capital spending is about 1.4% of American GDP, up from roughly 0.7%. So the economy is not 74% data centers. What is true is that data centers are doing most of the increasing. Strip that spending out and American growth is close to flat. Here is the number underneath that. In 2026, the 4 largest American cloud companies are guiding to roughly $725 billion of capital expenditure. Most of it data centers, chips, and power. That is not a forecast for the decade. That is 1 year for companies. So here is the plan. First, the bill, which is landing in specific places on specific people. Then the jobs. Then the money, which is where this gets genuinely strange. Then the strongest argument that all of this is worth it, and it is stronger than you think. And then what all of it adds up to. Start with the bill. Since 2020, average residential electricity prices in the United States are up more than 36%. Not all of that is AI. But in the grid regions where the data centers cluster, the fingerprints are hard to miss. In the PJM grid, the 13-state region with the densest concentration of data centers in the country, capacity prices rose 174% in a single delivery year. Power supply costs there went from $2.2 billion to $14.7 billion. Data centers accounted for nearly 2/3 of that increase. And it is not evenly spread. Since March 2021, average residential electricity prices are up 94% in Washington, D.C., 74% in Maryland, 73% in Maine, and 58% in New York. If you live somewhere else, this video is describing somebody else's bill. And $23 billion of customer price increases, driven by expected data center demand, are already locked in and running until at least the end of 2028. That money is spent. The question of whether the build-out works out is still open. The bill is not. Which is roughly why, when Gallup asked Americans in March whether they would support a data center being built in their area, 71% said no. In the same survey, only 53% objected to a nuclear power plant. And that opposition has become organized and effective. 833 organized opposition groups now operate across 49 states. More than 100 communities have passed moratoriums. State legislators filed over 300 data center bills in the first 6 weeks of 2026. And in the first quarter alone, at least 75 projects worth roughly $130 billion were blocked or delayed. Now, what does a community actually get in return? Brookings studied the local employment effects. Wages rise 3 to 4% for existing workers and new hires. Not 30. 3. And a good deal of what the build-out generates gets handed straight back. Georgia, Virginia, and Texas each give up more than $1 billion a year in data center tax incentives. Pennsylvania's break is projected to cost around $2 billion by 2031. Part 2. The jobs. Stanford economists have been reading the payroll records of 4.6 million American workers since ChatGPT launched. For workers aged 22 to 25 in the occupations least exposed to AI, employment is growing about 2% a year. Same age group in the most exposed occupations, it is shrinking at 3.8%. Relative to everybody else, employment for that group in AI-exposed work has fallen 13%. And almost none of it was layoffs. What collapsed was hiring. The roles that used to exist for people entering the workforce simply stopped being posted. Part 3. The money. And this is the part that reframes everything else. There is an annual gap of roughly $600 billion between what the hyperscalers are spending on AI infrastructure and what the entire AI ecosystem is actually generating in sales. Not profit. Sales. To put that in historical terms, the divergence between AI capital spending and AI revenue growth is running at about 46%. During the telecom overbuild that ended in 2001, the equivalent figure was 32%. We are further out over the edge now than they were then. So how is it being funded? Increasingly with debt. Forecasts put global AI-related debt issuance at around $570 billion in 2026. Loans to AI-related companies have gone from close to zero to over $200 billion in a few years. And across the whole ecosystem, analysts estimate roughly $1.5 trillion of external financing will be needed by 2028. And the structure of that debt is worth a moment. Private credit funds originate much of it, often through off-balance sheet vehicles. One example that lawyers keep pointing at. CoreWeave took a $7.5 billion facility secured against its own graphics chips and its customer contracts, at a variable rate averaging around 11%, with repayments starting in January 2026, just as the market value of that collateral was falling. Legal analysts have started drawing comparisons to structured finance before 2008. Not because it is the same thing. Because the pace of deal-making is outrunning the risk assessment. And who owns the upside if it works? The 7 largest technology companies now account for about 35% of the total market value of the S&P 500. Historically, the top 10 companies in that index averaged around 24%, and the previous high point was 28% in 1970. If you hold an index fund, you are already exposed to this bet whether you chose it or not. Now the other side, and I want to give it properly because it is much stronger than the comment section will allow. Stanford's Digital Economy Lab ran large representative surveys asking Americans what generative AI is actually worth to them. Not what they pay. What they would need to be paid to give it up. The answer, in aggregate, is about $172 billion a year of consumer surplus in the United States alone. And it is growing fast. A year earlier, that figure was around $116 billion. The adult user base went from 98 million to 115 million people. The median person's valuation more than tripled. And here is the detail that genuinely complicates the argument I have been building. That consumer surplus substantially exceeds all generative AI revenue in the United States. Which means, on this measure, consumers are capturing most of the value, not the companies. Now, one honest caveat because I gave the cost side one. That figure comes from asking people what they would accept to give these tools up, not from watching what they actually pay, and that method has a known tendency to run high. But it cuts the other way too. When the researchers offered people $500 to go without for a year, 12% refused outright. So the true number could just as easily sit above 172 billion. So I am not going to tell you this build-out produces nothing. It produces something enormous, and a lot of it is landing on ordinary people for free. Any version of this argument that skips that number is not worth listening to, including the one I would have made a year ago. But look at the shape of the two sides because the shape is the whole argument. The costs are local. They are immediate. They are certain. And they land on identifiable people whose bills went up and whose first job did not exist. The benefits are diffuse. They are aggregate. They are probabilistic. And they land on everybody a little. And that asymmetry is not a side effect of the build-out. It is the reason for every fight in the 4 videos before this one. It is why 71% of people oppose a data center they will never see the inside of, while cheerfully using the thing it powers. Those two positions are not hypocrisy. They are a rational response to being handed the certain cost and a share of the uncertain benefit. Which brings us back to the question. Who is actually paying? Right now, three groups are carrying it. Ratepayers in a handful of grid regions through their bills. Young workers at the entrance to AI-exposed careers through jobs that were never posted. And bondholders and private credit funds through roughly $600 billion a year of spending that revenue has not yet caught up to. And if that last gap closes, the third group gets paid and the first two were an investment. If it does not close, somebody eats it. That is the actual open question, and nobody honest can tell you the answer yet. So where do you land? Is this a real transfer, where the costs land on specific people in specific places and the upside concentrates in 7 companies and their shareholders? Or is it an ordinary infrastructure build-out where the value is already real, already exceeds the revenue, and is already reaching 115 million people? I have given you the strongest numbers for both, and I think a serious person can hold either. Tell me what would change your mind, and if you think I have weighted this wrong, say which number I underplayed. Everything here is sourced in the description.